Maya earns $100,000 a year. Her disability plan says 60%. Then an illness stops her from working. She expects $5,000 a month. Her first long-term disability check is zero. 90 days later, a payment may begin, based on a smaller income number, possibly reduced by other benefits. Then, in month 25, the plan may change the question that decides whether she is disabled at all. Maya did not misunderstand the multiplication. She read the percentage and missed the timeline. In the next few minutes, we will put her $5,000 expectation through 4 gates and show what can actually reach the household. Maya is fictional, and this is general United States education, not personal advice. Plans differ. But the 4 questions in her story apply to any plan. What triggers payment, when it begins, how it is calculated, and what makes it stop. Most financial plans are built on a quiet assumption. Next month, another paycheck arrives. We insure houses, cars, phones, and lives. But for a working household, the machine paying for nearly all of them is the ability to earn. Social Security says roughly 1 in 4 of today's 20-year-olds will become disabled before retirement. That is a lifetime risk statistic, not a claim that 1 in 4 workers becomes disabled every year. And it does not mean every condition will qualify under every policy. It does mean the risk is not remote enough to dismiss as somebody else's problem. And the cause does not need to look cinematic. It may be cancer treatment, a back condition, depression, a neurological illness, or an injury that heals well enough for ordinary life, but not well enough for the work that produced the income. That distinction matters. Health insurance pays eligible medical bills. Workers' compensation generally addresses qualifying work-related injury or illness. Disability income insurance is aimed at a different loss, earned income that disappears because sickness or injury limits your ability to work. The medical event is only the beginning. The financial event arrives when the paycheck stops, but the rent, mortgage, food, transport, childcare, debt, and health costs do not. So let us return to Maya and walk through the 4 gates between I have coverage and money reached my account. Retention reset. On screen. $5,000 expend. Counter Riemann's vid. Keep your eye on the $5,000. Each gate can change either the amount, the timing, or whether a payment exists at all. Gate 1 is the definition of disability, not the diagnosis, not how frightening the scan looked. The definition. Policies use different language, but 2 broad ideas appear repeatedly: own occupation and any occupation. An own occupation definition looks at whether sickness or injury prevents you from performing the material duties of the occupation described in the policy. Described they could still teach. A surgeon with a hand tremor may be unable to operate even though they could still teach. A camera operator may be unable to carry from a desk even though they could edit from meet. But the label alone is not enough. Some true own occupation language may allow full benefits while the insured works in another occupation. Other versions may reduce or end benefits when the person works elsewhere. The exact treatment of other work and earnings must be read, not assumed. And any occupation definition is stricter. It commonly asks whether the person can perform another gainful occupation for which they are reasonably fitted by education, training, or experience. It does not always mean literally any job on earth. It means the policy's particular test of suitable or gainful work. And some plans change definitions over time. A claim may be tested against the employee's regular occupation at first, then against any occupation standard after a stated period, often shown clearly in the plan, even if the employee never noticed it. Gate 2 is the elimination period, the waiting period after disability begins and before benefits become payable under the policy. 30, 60, 90, or 180 days are all possible designs. A longer wait can reduce the premium, but it moves more of the early loss back onto the household. And 90-day elimination period does not necessarily mean cash appears on day 91. It means the policy's waiting requirement may be satisfied then. The claim still has to be filed, supported, reviewed, and approved under the plan's procedures. Gate 3 is the benefit calculation. A common headline is about 60% of pre-disability earned income. But the hidden phrase is not 60%. It is covered earnings. Does that mean base salary, average commissions, overtime, bonuses, self-employment income? Is there a maximum monthly benefit? The answer can turn a familiar percentage into a very unfamiliar payment. Then come taxes and offsets. If an employer paid all the premiums, benefits attributable to those employer payments are generally taxable. If the employee paid the full cost with after-tax money, benefits are generally not included in federal taxable income. If both paid, payroll deduction usually does not. Part may be tax money. A pre does not count the same as paying with after-tax money. Some plans also reduce their payment for other income benefits, which may include Social Security disability or workers' compensation. The household may still receive money from more than one source, but the private plan's check may shrink because another source began paying. Gate 4 is duration. Benefits might last 2 years, 5 years, or to a stated age, provided the claimant continues to satisfy the definition and other requirements. Some conditions may have shorter limitations. Exclusions, pre-existing condition provisions, and maximums also vary. 4 gates: definition, waiting period, calculation, duration. Now watch what they do to the cleanest number in the brochure. The first gate decides whether Maya has a claim. The next 2 decide why a valid claim can still leave a household short. Maya is 42 and works in business development. Her base salary is $100,000. In a good year, commissions add another $30,000. Her fictional employer plan pays 60% of covered monthly earnings, up to its maximum. It has a 90-day elimination period. The employer pays the premium. For the first 24 months of benefits, the plan tests whether she can perform her regular occupation. After that, it applies a stricter any occupation definition. An illness leaves Maya with severe fatigue, pain, and cognitive problems. She can manage a short conversation. She cannot reliably travel, negotiate, analyze accounts, and sustain the schedule her role requires. Her doctor says she should stop working. That is medically important. But it does not by itself complete the insurance test. The claim needs evidence connecting the condition to the duties Maya cannot perform. Diagnosis answers, what is wrong? Functional evidence answers, why can she no longer do this job? Disability claims often turn on that bridge. Suppose Maya satisfies the plan's initial definition. Gate 1 opens. Now the calendar starts. During the 90-day elimination period, this long-term policy pays no benefit. Perhaps she has paid leave, short-term disability coverage, household income, or savings. Perhaps she does not. The policy does not solve that first cash flow problem. Its design assumes something else will. At the end of the waiting period, the headline calculation appears. 60% of $100,000 is $60,000 a year. or $5,000 a month gross. But Maya did not normally earn $100,000. She earned as much as $130,000 with commissions. In this fictional plan, commission is not part of covered earnings. So the $5,000 monthly benefit is 60% of base salary, but only about 46% of her $130,000 total compensation before disability. Nothing deceptive happened in the arithmetic. The denominator changed. Then tax enters. Because the employer paid this fictional premium, the benefit is generally taxable under federal rules. We will not invent a net figure, because federal and state outcomes depend on the person and the plan. The important point is that $5,000 is a gross benefit, not necessarily spendable cash. Now compare that amount with the household budget. The mortgage is $2,400. Health plan contributions and medical costs continue. Food, utilities, transport, and debt remain. The policy is working exactly as written, and there may still be a serious gap. This is the first reveal. Disability insurance is not designed to restore a former lifestyle dollar for dollar. It transfers part of the income risk. The uncovered part still belongs to the household. Payoff 1, on screen, expected, $5,000 immediately. Contract sequence, 0 during the 90-day waiting period, then up to $5,000 gross based on base salary, then tax and household costs. The percentage survived. The paycheque did not. Put Maya's first 2 years on one line. Days 1 through 90. No long-term benefit. After that, up to $5,000 a month gross while she remains eligible, based on defined salary rather than total compensation. Underneath it, household expenses continue at their own pace. This is the useful visual. Not a 60% circle, but 2 cash flow lines that never quite meet. And Maya's hardest gate has not arrived yet. For 2 years, Maya receives benefits while she remains eligible. Treatment helps, but recovery is uneven. She still cannot manage the travel, pace, and concentration of her former role. Then month 25 arrives. Petten inderropti, calendar stops. Contract question replices medical image. The illness has not changed overnight. Her old job has not become easier. But the contract now asks a different question. Before, can Maya perform the material duties of her regular occupation? Now, can she perform another gainful occupation for which she is reasonably fitted under the plan's exact definition? Imagine a vocational review concludes that Maya could work remotely in a lower-paid account support role. Whether that ends, reduces, or leaves her benefit unchanged depends on the plan's wording, its earnings threshold, the medical and vocational evidence, and any partial disability provision. That is the tension at the center of this product. So, 2 people with the same diagnosis can receive different outcomes because their occupations differ. The same person can receive different outcomes at month 24 and month 25 because the contractual test changed. Now add a second path. Maya can manage 15 hours a week, but only at half her former earning rate. A residual or partial disability provision may pay part of the insured loss while she works at reduced capacity. The formula is policy-specific. It may compare pre-disability income with current income, impose a minimum percentage loss, adjust over time, or interact with other benefits. So, I can work a little does not automatically mean my claim ends, and it does not automatically mean I keep the full benefit. Without partial disability protection, the contract may be built around a more all-or-nothing trigger. That can leave a difficult middle, too impaired to earn the old income, but not impaired enough to satisfy a total disability test. This is the second reveal. The best recovery can be financially complicated. Returning to some work may be good for health, identity, and income, while also changing the insurance calculation. The policy should tell you how those pieces interact before the claim ever happens. At month 25, the policy did not betray Maya. It did what it always said it would do. The danger was reading only the percentage and never reading the timeline. There is still one number many households add incorrectly. They assume a private disability benefit and Social Security simply stack the second payment. Often, the plan has already written the second payment into the first. What about Social Security Disability Insurance, SSDI? SSDI is not simply a free version of an own occupation policy. To qualify, a worker generally needs sufficient recent work history and a medically determinable gainful activity that prevents substantial gainful death, or has lasted, or is expected to death, or has lasted, or is expected to last at least 12 continuous months. For non-blind applicants in 2026, Social Security ordinarily treats monthly earnings above $1,690 as substantial gainful activity, subject to its rules and adjustments. That figure changes over time. There is generally a 5 full-month waiting period after the established onset disability before SSDI cash benefits can begin. An application also requires a decision, and any denial and appeal can add more stages and more time. The estimated average monthly benefit for all disabled workers in January 2026 is $1,630. An individual's actual benefit depends on their covered earnings record, and eligible family benefits can change the household total. That money can be essential, but average is not adequate for every household, and eligibility is not automatic. SSDI is its own program with its own test, not a promise to replace a chosen percentage of salary. Now return to Maya's group plan. If the plan contains an SSDI offset and Maya later receives SSDI, the private benefit may be reduced under the plan's formula. That is not necessarily lost household income dollar for dollar. It may be a change in which program supplies the money. But it means she cannot assume the two headline amounts simply stack. Payoff 2. Two cheques slide together. Total does not simply. There are other gaps the 60% slogan cannot show. Some policies limit benefits for specified conditions. Some exclude a pre-existing condition for a defined period. Some cap monthly payments even when 60% of income would be higher. Some include rehabilitation or return to work features, although conversion or continuation rights may exist in particular plans. And employer plans covered by ERISA have formal claim and appeal procedures. The summary plan description. The SPD explains how the plan works, what benefits and limitations apply, and how to file a claim. The Department of Labor says the plan administrator must provide it on request. The gap between a benefits enrollment slide and the SPD is where most of this episode lives, and that gives us a practical ending. Not 50 pages of insurance vocabulary. 7 lines copied from the document that actually controls the claim. You do not need to become an insurance lawyer to get a clearer picture. Start with 1 document and 7 lines. Retention reset. 7 upvoted lines fill, as each item is spoken. Line 1. Definition of disability. Copy the exact words. Does the plan test your regular occupation, your own occupation, any gainful occupation, or a sequence of definitions? Line 2. Definition change. If the test changes, when? Mark that date on a timeline. A 2-year payment period and a 2-year own occupation period are not necessarily the same thing. Line 3. Elimination period. How many days must the household fund before long-term benefits become payable? Then ask what paid leave, short-term coverage, or cash reserve is meant to bridge it. Line 4. Covered earnings. Base salary only? Commissions? Bonuses? Overtime? Look for the maximum monthly benefit as well. Calculate the percentage against what you actually earn, not only against the plan's smaller definition. Line 5. Premium source and tax treatment. Employer paid, employee paid pre-tax, employee paid after tax, or shared. Do not guess the result from the logo on the policy. Confirm it with the plan and, where needed, a qualified tax professional. Line 6. Other income and partial work. Which benefits can offset the payment? What happens if you return part-time or earn less in another role? Find the residual or partial disability formula, not merely the word included. Line 7. Duration, limitations, and exit. How long can benefits continue? Which conditions have shorter limits? What exclusions apply? What happens if you leave the employer? Now put the numbers on one page. Expected gross benefit, whether it may be taxable, the waiting period, cash need, essential monthly expenses, and the remaining gap. That page will not tell you which product to buy. It will do something more useful first. It will tell you whether the coverage you think you have and the coverage described by the contract are the same thing. Viewer action. Pause here. Open your summary plan description and fill in the 7 lines. If one line remains blank, that is the next question to ask your plan administrator or licensed professional. Disability insurance protects an asset that never appears on a bank statement. Future earning power. Its headline is a percentage. Its reality is a sequence. First qualify under the definition. Then survive the waiting period. Then apply covered earnings, taxes, caps, and offsets. Then remain eligible for the promised duration. For Maya, 60% became no payment during the waiting period. Then $5,000 gross, based on base salary. Then a new eligibility question at month 25. Every step was visible in the fictional contract. None was visible in the headline. Final playoff. Return to the $5,000 counter. The right number was never just 60%. It was 60% of what? Beginning when, taxed how, reduced by what, and payable for how long. That does not make employer disability coverage worthless. A group plan can be a valuable foundation. Individual coverage can address different needs and may offer different definitions or portability. Neither label tells you whether a particular policy fits a particular household. The terms, the budget, and the gap do. Your documents and circumstances control your result. Read the actual contract and use appropriately licensed help before making a decision or acting on a claim. We have now unpacked 2 ways a household's own income can stop: death and disability. Next time, the loss comes from the other direction, not what happens to you, but what you may owe after something happens to someone else. 3 small numbers on an auto policy can decide whether the insurer absorbs that loss or whether it reaches your savings. This is Policy Unpacked. Subscribe and we will unpack those numbers next.